In this video, we'll look at the transmission mechanism of monetary policy and see how it impacts an economy. The monetary transmission mechanism is a process by which a change in the rate set by the central bank ultimately leads to changes in aggregate demand, real GDP, and the price level. The central bank sets an official rate at which commercial banks can borrow from it, and it also influences the overnight lending rate between banks. If the official rate changes, it may eventually have an impact on real GDP, employment, and inflation. The official rate works through a series of channels by which it will eventually influence the price level and real GDP. We'll examine the relationship between the official rate set by the central bank and market rates, wealth, expectations, and the exchange rate. You should be aware that the official rate is the rate at which commercial banks borrow directly from the central bank. If the cost of borrowing from the central bank rises or falls, this will have an impact on the variables you see here. Let's consider each in turn. We'll start with market rates. Market rates are the rates charged by commercial banks to borrowers for a variety of loans, including personal, business, auto, and home loans. These rates tend to move in the same direction as the official rate. There is a spread between market rates and the official rate, as this is how banks make their money. If they are borrowing from the central bank or from other commercial banks, they will need to pay interest. Therefore, they make loans out at rates above the rate at which they've borrowed funds. If the central bank increases the official rate, this will likely lead to an increase in the interest rate charged to borrowers. This will cause borrowing to decrease as it is now more expensive to borrow, and this should cause savings to increase as it is more rewarding to save. Conversely, if lending rates decrease, then borrowing is likely to increase and saving is likely to decrease. This will lead to either an increase in consumption and investment or a decrease, which will have an impact on aggregate demand, real GDP, and the price level. If borrowing increases, aggregate demand and real GDP are likely to rise. This may have an impact on the price level, but the ultimate change will depend upon the level of spare capacity in the economy. Next up is wealth. The definition of wealth includes all of one's assets minus all of one's liabilities. The two assets we will focus on for the transmission mechanism will include real estate and stocks. A change in market rates will impact real estate and stock prices. Higher interest rates increase the cost of borrowing and reduce the demand for house purchases, and vice versa. As demand for real estate drops, housing prices will fall, and vice versa. As the value of their assets fall, individuals are less likely to spend, thus reducing aggregate demand. So let's see what would happen if market rates drop. So if market rates drop, the demand for real estate will rise, increasing real estate prices, and that would result in an increase in wealth. So when people feel wealthier, they're more likely to spend, and then this will lead to an increase in aggregate demand. Stocks or shares are impacted by changes in interest rates as well. Lower market rates cause investors to seek better returns from other financial assets such as stocks. As demand for stocks increases, so does their price. In general, higher stock prices leave investors feeling wealthier and thus likely to spend more, and then this will likely increase aggregate demand. Expectations are also influenced by central bank decisions. If the central bank is reducing interest rates, it is pushing for economic growth and an increase in real GDP. This will shape the behavior of firms and individuals. However, if the central bank is increasing interest rates, it is likely perceiving inflation as a threat. And then this will also shape the behavior of firms and individuals as they respond to the actions of the central bank. There is also an impact on the exchange rate when interest rates change. A change in the interest rate paid on deposits will either result in capital inflows or capital outflows. A higher interest rate is likely to increase demand for the currency, which will cause it to appreciate. A lower interest rate will cause the demand for the currency to decrease and likely cause it to depreciate. So the change in the value of the currency will impact exports and imports, or the net export component of aggregate demand. As net exports rise or fall, all else equal, aggregate demand will move in the same direction. If the currency appreciates or depreciates, this will also impact imported resource costs. If the currency depreciates, imported resources will become more expensive. However, if the currency appreciates, imported resources will become cheaper. The impact of this change will affect aggregate supply as the cost of production for firms will change. The impact from each of these channels will eventually have a combined effect on real GDP, aggregate demand, employment, and thus the price level. You should be comfortable explaining how the official rate will impact each of these channels. Additionally, you should be able to connect changes in the official rate to their intended impact on real GDP, aggregate demand, employment, and inflation. Another important factor to remember is that there is a time lag of monetary policy of approximately 12 to 24 months, as it takes time for the policy changes to impact the various channels and thus the economy. If you are evaluating monetary policy, you should introduce the time lag, but be specific and include details about the transmission mechanism to supplement your discussion. By now, you should be able to explain how the transmission mechanism of monetary policy works. If you have any questions, leave them below and let's try to answer them together. That's us done for now, and I will see you in the next one.